We're diving deep today into maybe the biggest question in finance right now. Where is Bitcoin going? And maybe more importantly, when? We're taking two very specialized and on the surface sort of contradictory viewpoints. One is this long-term cyclical geometry that predicts tops and bottoms years in advance.
And the other is the complete opposite. It's the immediate granular data of short-term liquidity, the microstructure.
So the goal for you listening is to really get how top analysts blend these two things. We're looking at the work of Mr. P on the macrocycle side.
And Bleeding Crypto, who tracks these immediate liquidity clusters. It's like asking if the big long-term map still matters when you're looking at the tiny footsteps on the ground.
That's a perfect way to put it. One gives you the destination 5 years out, and the other tells you where the potholes are today.
Right. And you kind of need both, where you either lost or, well,
Yeah.
you're getting wrecked.
Okay, let's start with the grand view, the big geometry. Mr. P's method uses something he calls a fib triangle chart. This isn't a standard tool, is it? Can you explain the thinking behind it? Why geometry?
Well, the idea is that Bitcoin cycles are, they're not random. They're driven by the halving events, which create these repeatable, almost logarithmic growth patterns.
Okay.
Fib triangle, which grew up way back in late 2024, isn't just tracking price. It's tracing the decay rate of those previous growth cycles and measuring the time-based retracements. It's unconventional for sure, but it's been weirdly accurate at calling the timing of tops and wicks.
I want to get right to the timeline because the market feels tense,
Right.
stretched. Based on that geometry, are we still technically in a bull market?
Technically, yes. According to the structure model, we are not in a bear market yet. The window outlined for the cycle top, I think it was November 2nd to December 15th. That still holds.
But we're getting close.
We are rapidly approaching the tip of that triangle. I mean, analysis points to the peak timing being effectively right now, or, within the next 2 to 4 weeks.
That is an incredibly tight window. Okay, before we zoom into the micro, let's just nail down the long-term risk. Where does his geometry say the floor is for this next big correction? He seems to dismiss targets like $170.
Yeah, those higher targets as pretty unrealistic for this cycle. They'd require an acceleration that just doesn't fit the logarithmic decay model. The math isn't there.
So what is the floor then?
Minimum target, based on historical fib retracements and the scale of this cycle, is $70,000 by April 2027. That's the point of capitulation. For the cycle to maintain its structural integrity, it needs to hit that.
So we have our boundaries, a potential quick spike to $130 and a long-term floor at 70K. That's the macro map. But how do we trade this minute to minute? Let's bring in Bleeding Crypto's work. What exactly are these heat clusters?
Okay, so heat clusters are basically these super dense zones of liquidity. They show us where the major players, the market makers, are placing their bets.
So they're not just random lines.
Not at all. These are huge concentrations of limit orders, the bid and ask walls from institutions' exchanges. Price gets drawn to them like a magnet. When it gets close, you almost always get a strong reaction, a bounce, or a sharp breakthrough. It's our roadmap for the week or even for the day.
But can't those be faked? I mean, can't a market maker spoof a huge buy wall to trick people, then pull it at the last second?
That's a great question. And yes, spoofing is a real thing. But the clusters we're talking about here are the ones validated by a ton of historical volume and positioning across many exchanges. They're harder to fake than a single order book.
And what are they telling us right now?
Well, the current structure is actually short-term bullish. Bitcoin just bounced hard off a major cluster, and it formed a higher low and a higher high. But this is also where we see the immediate warning signs that the big macro model might miss in real time.
The warning signs? You mean bear divergences. For anyone listening who needs the detail, how do you actually spot the difference between a real move up and one that's just running on fumes?
A divergence is when the internal strength of a move is fading. So you might see the price making new highs, but the momentum behind it, which we can measure with things like the RSI or volume, is making lower highs.
So give me a concrete example.
Okay, let's say price hits $120K, and then it pushes to $125K. But the RSI indicator made a lower peak at $125K than it did at $120. That's your flashing red light. It's telling you the buyers are getting exhausted and the move is on borrowed time. That's the #1 signal a big pullback is coming.
So the clusters give you the price zones to watch.
And the divergences give you the timing for an entry or an exit.
So how does a trader put this together in practice?
It's all about execution. The clusters give you a high probability roadmap. You see price approaching a major cluster, you don't just jump in, you watch the reaction. Does volume spike? Do you see a divergence confirming a rejection? You wait for that validation.
This is where it all comes together, connecting the long-term map with the immediate road signs. Does Mr. P find that his big geometric points actually line up with these real-world liquidity clusters?
This is what's so fascinating. Your discipline has to be driven by data, not hope or what you're seeing on social media. Rely on the clusters, rely on the divergences, trust the geometry. The market moves on liquidity, not on your wish for a new high.
What about staying flexible?
Absolutely essential.
Mhm.
Even if the macro cycle is pointing down towards that $70K floor eventually, these markets will have huge counter-trend rallies. You can trade those safely if you're watching the clusters and the momentum.
And it all comes down to risk management.
It's the foundation. Knowing the long-term floor is $70K should inform your overall holding strategy, while the microstructure of the clusters inform your daily or weekly trades.
This has been incredibly useful. So, for you listening, we have set the structural boundaries. Okay, for our final thought, something for you to explore on your own. We rely on these models being consistent. Mr. P's geometry assumes the historical cycles repeat. Bleeding Crypto's clusters assume institutions position themselves in predictable ways. But what happens if the underlying mechanics of the market actually change?
That's the million-dollar question. I mean, if new regulation comes in and changes how high-frequency trading works, or if market maker tech evolves to hide liquidity better, our micro roadmap could change overnight. The clusters might become unreliable.
And the knowledge we've gone through today is invaluable for this cycle, but the constant challenge is adaptation. Does the math stay true even if the market mechanics that drive liquidity shift entirely? That's the strategic question you have to keep asking for all the cycles to come.